Let's do a couple things and just go over a few things. It might be a long highlight, but let's just watch the at 9:47 right here. 9:47. Where's that at? We had an interesting combination of shorts jump in right there. All right. And then they didn't disappear because 2 minutes expired. They disappeared and because they got filled and they covered. And the laser went really long red to green because they covered at some point. And so if I not fast forward it, just play it. I screwed up. If I just skim across right in here, boom, see it disappear? Let me rewind it to the point where it does it. All right. So it's net short, net short, net short, net short, gone. And it's going to go red to green, which means more longs than shorts in the last 2 minutes. And then the market sells off, comes back to our area of resistance, the green PWAP right here, and comes off. But just that's interesting in here when it goes green, comes off, boom, shorts come back in right here, goes up, stay short, stay short, stay short, go up. And then look at this, red to green, down. So red, I'm looking at right here, by the way, red laser to green, right there, down. All right, 9:16. What do we have at 9:16? The combination green PWAP, this is the dotted line here. Iceberg shows up. And I think it was one of the first times where, no, it wasn't. It went, again, another example, red, green, near resistance, down. All right. Now, this is something that in the first hour on these sessions, around 9:07, it happened. But this is what this became kind of like the theme of the last few sessions. When you have sessions that open up and stay like in a 8-12 point range in the S&Ps, you get yourself in trouble if you're looking for a trade. You got to let something slap you in the face, because what you get at the top of consolidation. Just take a look here. There seems like there's a lot going on this chart, but once you understand some of the features, there's not. It's just the same thing, just different time periods. But look over here. You got the top of a range and you got the bottom of a range. All right. Now, what happens is every time we get to the top, you get longs that try to jump in looking for a breakout to the upside. That's not going to be advantageous for a breakout to the upside. Too much competition. All right. So you get red to green, boom, we come off. And then other examples, I'll just take it back to, let's say in here, you're looking for some downside in here, breakout to the downside, and goes green to red. Now, at 9:30, we finally had something that literally got me to sit up in my chair, because we finally got a moment where the market had some downside. Might have had some downside. Where was it? Right in here, as before 9:30. Might have had some downside follow through, and it did. And you're getting dizzy looking at the screen, but just follow me. Right now, it's doing the same crap, trying to break out to the upside. Too many longs, comes off, right? And then all of a sudden, you get this pretty decent quick move down. And it gets longs in this sequence to look like this, if you could see it. This is what longs look like. And they're soon to have a couple scars on them. When longs look like that is when you can get some follow through to the downside. Now, it was this bar in here that created that. All right. And so as we kind of move along, and you could see some follow through and then another nice move lower, a touch and a tag of the average shorts, which is our red dotted line up there, chopping around it, ends up getting too green and blasting then below it right in here. It's red going into the green PWAP. Oh, and I showed you this. And then it came off. And then we had, what time was that where we had all those greens? That was right in here. Take a look at this. This was a moment of, it was like 400. Yeah, here it is. See this number here right there? 400. That's how many longs are in the market over the last 2 minutes. So you see it visually with these green bars that stick out. All right. And you see it in a laser that we call it, how long and it gets inside the footprint bars. And then you see it in a raw number down in here. All right. So you got a lot of longs. Let me back it up to where they all come in. You could see them popping in. Watch them pop in right here. And so this is just something to, if it doesn't get you short, fine, but it should keep you from being long, staying long, or wanting to get long. Because you got competition. And so you see the greens, the longs come in, price breaks. You see more longs come in, price breaks. Then you get to the point where these are a lot of longs here at 52 even, 51 even. Now they're going to disappear only because of the 2-minute expiration on them. But there still remained a cluster of longs there on our 60 minutes. So we knew that they were still there and stuck there. And so when we fast forward it, we talk about that area being overhead resistance, which is 51.52 right here. All right. Right in here, because that's where the market is stuck long, and it goes up into there, stops, and rotates back down. So if I were to draw it, it's like 51.52. Let's say 51.52 is right there. When those longs opened up, we broke and we came back up there, tested it, and then rebroke back down. That's what it would look like on a line chart. And so this becomes real-time resistance, which when you have real-time resistance and resistance for a reason of other people trapped, stuck in a position, you get the baby bird story where you're getting longs. And at this point, if you watch enough of these videos, longs equal shorts. Hopefully, at least we know, I'm sorry, longs equal shorts. Kidding me? Longs equal sellers. And if you watched my videos or been in this room, you know that. And so if there's too many longs and they're trapped at a particular moment, you probably get them thinking, man, if it could just get back up to where I felt all this pain, because I got long here and I felt all this pain. If you could just get me back up, break even. And if they're religious, they pray to God, I'll never, ever do this again. And the market comes up and then comes back down. And part of the reason why it comes back down is, number one, the reason why it stops there is because you got a lot of sellers trying to exit a long position. And the reason why it comes off and goes down is because those sellers start to get anxious and say, I'm not getting filled. Screw it. I'll try to sell lower. Screw it, screw it, screw it, screw it. And the dynamic of that is the definition of good support resistance. It's the definition of it when it works. It's the dynamic generally at play when your lines of support or resistance work. If you can't understand it, you're never going to have good lines of support resistance, and you're never going to use it. And then use it also when they don't work as a good transitional moment. But you have to have a certain dynamic like that at play. And the definition of why lines in the sand, if that's what you call them, or whatever they are, targets, LVNs, HVNs. People use different reasons or have different reasons for different zones and areas. The dynamic of what I just explained needs to be at play for them to work. And so, sure, you might have an LVN, which is a low volume node, as a profiler would call it, and you need some trap longs or shorts there. Longs if it's going to be resistance, shorts if it's going to be support. It always goes back to the premise of after you're long, you're a seller, and after you're short, you're a buyer. And so it goes into understanding price action, order flow, and trading in general from this golden rule, which most people don't understand, take the time to learn, realize it's something that's important. And so a lot of people jump to chapter 20 in trading, and so they miss the important chapters. And the important chapters, the basic chapters in trading, are in this industry the most important. And the reason why is because most people skip over them. They don't understand why price moves, and yet they're trying to predict it. So it comes into this premise of after you're long, you now become a seller. After you're short, you now become a buyer. Too many longs, too many sellers. Does that make sense? Too many sellers and the price of something would go down, right? It's kind of like you need that for price to go down. I had one guy say, well, it'd be nice to have too many sellers for price to go down. I said, nice? No. Necessary. That's why it goes down. Too many sellers and then trying to sell it, but they can't. If they sell it and get filled, you kind of don't have any more of that selling, but you want to get them stuck. You want them trying selling it. You want them whining and squealing and complaining. They're trying to sell it and they can't get filled. And that's what makes price go down. And again, it's the price of a house, of a car, of a plane ticket, of the S&P E-mini futures, crude oil, everything. And then people talk supply, demand, inventory. Okay, we'll go deeper than that. What do you mean supply, demand? Where's the inventory come from? Where and how could you put it in perspective to create a predictable moment or high probability moment so that you have an advantage over those you're trading against? And so it's not using price to predict price. You have to anticipate where price might go in order to profit from it. Because to get bullish after we rally is often too late. To get bearish after we break a lot is often too late. You get caught reaching. And that's an early problem in most people's trading career is they're long late, short late, because they let price dictate their bias, their opinion. And so if you're always getting bullish after price goes from here to here, no, you need to anticipate and stack probabilities in there that it's going to go here. And you're more likely getting out there than trying to get in. People getting in after a rally, getting in long, are putting ladders on picnic tables trying to pick apples. Putting a ladder on a picnic table trying to pick apples. Sure, they might get an apple now and again, but the risk is too high. They're on the top rung of a ladder on a picnic table trying to pick an apple. So you need some low-hanging fruit. You need some skills to create probabilities, and that sharpens your predictive skill and tools, really. But yeah, price doesn't predict price. Other people's positions do. And if that premise isn't somewhere at some point you start or return back to, everything else becomes harder or irrelevant, really.